Yeah, so my background, I had done a startup about 20 plus years ago and then realized that it's very difficult to do a startup. And so then I had the pleasure of working at, big firms like McKinsey and Company and Goldman Sachs. And so when we started Embarc, the idea was let's create a firm that is like the McKinsey of the middle market, an advisory firm that really delivers the highest level of strategic advisory to business owners and founders. And we focus on corporate finance aspect of that because we're very M&A focused, but really we want to be kind of like thought partners and problem solvers for our clients. I'm a very good M&A advisor. I'm an expert in M&A, but I was never a good salesperson. And I didn't know how to pitch. Also, pitching with under the umbrella of a big firm like Goldman Sachs is very different when you're pitching as a one-person shop. I didn't have the track record. I didn't have really the talking points to address this market. So that was probably the most difficult part in the early days. And I remember it was almost like during the day, I spent all my day doing business development. I would work on the projects late afternoon, evenings, and it was kind of like that in the beginning. In the beginning, I had the benefit of having a very strong resume. So I would talk about my background as a former investment banker from Goldman, a consultant from McKinsey and Company. I had my MBA from Wharton. So I think that was certainly a big leg up, the fact that I had those big names in my resume. Um, but inevitably, people will still ask, oh, have you worked in this industry or have you worked on businesses of this size? And I didn't have that. And that's kind of where it was difficult for me to establish credibility. And the reality is, M&A is very much a functional expertise than really anything to do with industry expertise. And if you look at the top investment banks like Goldman or Evercore, the M&A bankers there, they work across different industries. They're really viewed as execution experts and less so industry specialists. And so similar to like law or tax or accounting, M&A experts tend to focus on kind of their functional expertise than industry specialization. So to kind of compete against big firms where they position themselves as, oh, I'm the M&A person for IT services. I'm the M&A person for landscaping. I think we really need to kind of demonstrate that we have functional expertise, that we bring expertise and depth of knowledge and execution that other people don't have or don't talk about. And that led us to kind of like really sharpening our pencil around core functional tools like doing a seller's quality of earnings, talking about qualified small business talk, Section 1202, structuring earnouts so that they are attainable and so forth. So going beyond like the standard, oh, there's a sim, a teaser, and an LOI. Like that's very basic stuff. And we had to kind of dig deeper into to kind of demonstrate our expertise. I think it's an easy proxy and it's an easy question to ask because oftentimes when a client is hiring, an M&A person, a tax person, or a digital marketing person, they don't know anything about M&A or digital marketing. It's easier to qualify that person and talk about it if they say, well, tell me about your experience in e-commerce. Well, this is what I did for M&A and e-commerce. Now there is some overlap in the conversation. It allows them to engage more. But, I always emphasize that we have done many, many deals that are very successful that were in industries that we had never touched on. So last year we sold a company that was in the aerospace sector. This company had failed to sell twice, once with an investment banker. And we sold it with flying colors. They got over a dozen bids, and a few of those bids were way beyond what the seller was looking for, and it was a successful transaction. And it's not because we knew the buyers. It's not because we knew the industry. It's because we are M&A experts, and we knew how to run a deal like that. And that's kind of like our constant struggle to be able to demonstrate that. And the last thing I'll add is, you know, the customers or the clients see that M&A advisors go around saying, oh, I'm the M&A advisor for IT services. I'm the M&A advisor for aerospace. And I always let them know that the reason people do that is because it makes their life easier. It's a lot easier if I am a person that's dedicated to a sector, because it means I just keep going to the same conferences, keep talking about the same deals, keep talking about the same buyers. And it's a convenience for the M&A banker so that they can sell more easily. Does not mean that they're going to get better M&A advice from those people. So that's that's one of our hurdles as a smaller firm trying to cover a variety of industries. To be honest, there weren't much expectations. The introduction came from one of my business school friends, and his CFO knew someone that needed help with some M&A. So this was multiple degrees of separation. I didn't know anything about the company. I just knew that it was an introduction. This was early days for the firm, so I will take every introduction. And most of those introductions are very small companies. Some of them aren't even a fit. But obviously, I would still take the conversation. So I didn't really have much of an expectation. And when I remember I was taking that call, and it was actually a much larger company than I thought. So or I typically talk to. So that was a nice surprise. I remember having the conversation with there were two business owners. I was talking to one of them, and of course they asked the same question: have you done any work in this space, and all that stuff. But I think we built a connection because, I told them about how we build hourly, and that, I mean, I think that's still very novel that we build hourly. I don't come across a lot of firms that do that, if any. And I think certainly 5 years ago, it was very interesting. And so he kind of dug into that, like, why would you bill hourly? And we kind of talked about how the hourly model is really set up for us to help them on everything they need, more attention. And then it kind of boiled down to, it allows us to take less clients and pay more attention to them to make sure that they get the best quality service. I think that kind of struck a chord with him because it's like, oh, that's exactly how we think about it. That's our philosophy as well. And he liked that we shared that philosophy. And he said, so you're like basically the Jerry Maguire of finance. And it had been a while since I watched that movie. And I remember that after one of Jerry Maguire's clients had like a health issue, he wrote that manifesto: less clients, less money, but more personal. And that kind of that stuck with me too. And I still use that analogy from time to time, because that's really what we are at the core of it. We want to be, we're okay taking less clients, but we want to make sure that every client that we take on, whether they're large or small, gets the best possible advice. No, we were also a new firm back then, and I think they kind of appreciated that, I brought in a strong background. And again, like, this company was a little bit larger than many others, so they were doing tens of millions in revenue, and they've been around for 20 plus years. So I think I would say they appreciated the higher quality advice. I think a lot of folks, for one reason or other, can be very cost sensitive and can also be quite concerned about anything that's related to hourly billing. I think these guys kind of really understood the value of the advice they would get. And they specifically said, they weren't enamored with the traditional brokers because, they already know all the buyers. They were getting calls all the time from potential buyers saying that people would buy their company. So they knew the buyers. They didn't need help with that, but what they really needed was advice. And I think they understood that our business model was geared towards giving them the care and attention they need and the advice in the objective way, because we're not going to push them to do a sale. Even if selling's not not the best direction, then we would tell them what the best direction is. Yeah, this is a business they built for 20 plus years. I would say 90% of their net worth was tied up in that business. And selling a business like that is a big decision. And this was also a sizable business. If it sold, it would be multi-eight-figure wealth for each of them. So, and M&A is like one of those things where you don't get to do a do-over. If you sell, it's sold. And if you find out later that you inked a not so great deal, at least in marriage you can get divorced. So in this case, you can't even get divorced. So there are no do-overs. They understood that the stakes were really high, and so they were really looking for a deep level of guidance and advisory. I think these guys, they were in some peer groups where there were a lot of business sellers, and when you kind of dive into it, I think they've heard a lot of these regret stories where, people rolled equity because they were promised that second bite of the apple would be 3, 4, 5 times, sometimes more, and never materializes. They were given a big earnout, and it seemed so attainable, but then the moment that they sold, they realized very quickly that earnout was not going to become attainable, and they realized that they could have gotten more cash or a higher multiple. And when they see that all of these other sellers had gone through these issues, and even after the fact, they know that they made a mistake, but they don't know what they could have done to avoid that mistake. I think in some ways it's terrifying. And they wanted to make sure that they were buttoned up from all different directions. This was a while back, so it was typical setup. We had a director and an associate, and M&A is such a fast-paced, multifaceted thing. I think it's very difficult for one person to do it all. And the associate would build up the model, crunch numbers, do the analysis, manage the data room, and the director is kind of project managing it. Making sure the quality is there, making sure nothing falls through the cracks, and all the moving pieces kind of chug along at the right pace. And then as a principal, I would have calls with the sellers, the buyers, negotiate the LOI, solve any of the issues that come up during diligence. And so it's a real team sport. I think M&A is a very team-oriented activity. And then we would work closely with the lawyers and the CFO, the tax people, and all of that. So it was a big lift. So this was one of the first M&A deals that we worked on. And this company, again, it was scaled. It had a very involved fractional CFO. They had an accounting team. And they said that their books are clean, their books are good. And so we kind of took that at face value. And so this is the first deal, one of the first M&A deals we worked on. We did not do a seller's quality of earnings at that stage, and we kind of dove into it. Now, there was a buyer that the owners were already familiar with. They got an offer that they thought was good, and they pursued that with that private equity firm. And when the buyer brought in their quality of earnings firm and started going through the numbers, we realized that the books were not as clean as we thought they were, and there were a lot of issues, and it was almost like death by 1,000 cuts. So lesson learned there. After that, we built out our own quality of earnings teams internally. So every company that we sell always has a seller's quality of earnings ready to go. That was like a big lesson learned. But yeah, it was very difficult, and the buyer was like chipping away at the EBITDA little by little by little, and was genuinely concerned that they would retrade on value. Thankfully, they did not, and we kind of slogged through that to keep it on track and make sure it didn't fall apart. But yeah, that was a big lesson learned, that even companies that are doing a decent amount of accounting, have a fractional CFO. They don't really have exit ready financials. That's a completely different ballgame. And in hindsight, it was very obvious. If you look at private equity firms, their portfolio companies are audited. They have really good accounting, GAAP, accrual. They have a full-time CFO. When a private equity firm sells their portfolio company, they still do a quality of earnings. So the notion that a owner-operated business that might not even have audited or reviewed financials can just go out and sell itself and think that it's gonna come out unscathed, I think was very naive at that time. And so again, lesson learned. If the business model, like a traditional broker, is, we do a lot of work, and then after whatever, 3, 6 months when we sell, that's when we get paid a lot of money. In that business model, first of all, not every deal gets done. And also, you're not getting paid anything for the whole interim period. You have to manage your costs. From the M&A advisor's perspective, it becomes very much of a manage my costs, portfolio of deals, and then whenever one of those hit, I make millions of dollars. And again, that kind of limits the time and attention you would put into each of these companies. We even had one company recently where the books were so bad that when we looked at it, we decided that it would be better if we reconstructed the books from scratch the last 3 years. It took us probably about 5, 6 weeks to do that, but we can do it. It takes a lot of time and effort to do it, but we can do it. And we've got all the bank statements, all the credit card statements. We created a new QuickBooks instance, and we basically recreated the books. And then a senior person checked those books. So it was like doing 3 years worth of accounting in 6 weeks. But that's going to make sure that this business succeeds when it goes out to sell. If we went out with those messy books and try to explain away all the blemishes, I think that's like the big difference when you have an hourly model. The goal is still to sell the company, whether we, get paid a success fee or not. That's like the whole reason for this firm exists. But we can put in the effort to make sure it's prepared really well. And I think that's why we have a very high close rate, actually, because we will look at all those issues and preemptively address them before we start talking with buyers. We went through the death by 1,000 cuts with this private equity buyer, and we got through diligence, we got all the documents ready, but ultimately our client decided to not sell. Got to the finish line and decided to not sell. And I think there was 2 reasons. One is, I think through that diligence process, they realized that this was not going to be the right home for their business. These guys were still relatively young. They wanted to keep working, and this was going to be like an irreversible marriage where they would have to work with that private equity firm they sold to them. Otherwise, they're going to have a 5-year non-compete, so they would not be able to go out and do something else. The second reason was, having gone through the private equity diligence process, they kind of realized that it's not rocket science. It's not rocket science. And they actually asked us, hey, couldn't Embarc help us do this? Where exactly what private equity was doing, can we raise capital, go buy a business, keep increasing value, integrate those businesses and keep increasing value? And 100% we could. And so I asked them, well, why did you guys want to sell in the first place? And they told me that they have a big family and they wanted to buy a big house. And so they wanted to have the liquidity and all that. So now there's a little bit more clarity. So at the headline of I want to sell my business, there are really 3 goals. One is I want to sell, but I want to keep working. So now the sale is not just about maximizing value, but the sale is also about finding the right home for them. Number 2 was they want to create more value, and they saw that opportunity to do that. And number three was in the immediate term, they wanted some liquidity so they could buy a big house. And I felt like, so those are the real client problems. And so we tackled each one of them. First of all, I'm going to go in reverse order. First one, okay, so you guys need a lot of liquidity. And so same thing, we took a page out of the private equity playbook. And what we did was we helped them raise debt. We basically helped them do a founder-backed recap. So instead of selling a portion of their company, we raised a ton of debt, let the founders take that money off the table. That gave them millions of dollars to go buy whatever home they wanted to. So they did that. So now that first issue is solved. And then the next thing was they want to do some acquisitions because they saw what private equity was doing is buy at a low multiple and then they'll sell a high multiple, which is very doable. And they already had some targets in mind. So same thing, we helped them raise capital. We helped them, diligence on the buy side, do all the buy side work that private equity would do because, people on my team were former private equity, former corporate development people that know how to do that. So we ran that whole process, helped them do acquisitions. And that created a lot more value. And then so we worked with them for about another 12 months since that first transaction. And along the way, because we saw all the problems in the first transaction, we got everything ready. We cleaned up the books. We improved financials. They also knew what to work on. So they grew the business significantly. So it became a lot better business. And this time we did our own seller's quality of earnings to make sure we don't make the same mistake again. And so now we're fully buttoned up. And this time, instead of just negotiating with one person that they already knew, we went out, we did a broader outreach, full auction process, got multiple bids. And several of the bids kind of came in above market. And now here's where it gets interesting. There was a buyer that was willing to pay more. And we had lots of bids. And I told him, look, these guys are going to pay a few $1 million more. But I think you should take this bid. Over the last 2 years, I've gotten to know you guys. I know what you like. I know that you like to do these like big family travels. I know that you guys don't like to work 60 hours a week. And if you take this bid, you'll make a few more $1 million, which is not a small amount of money, but you will hate your life. You're gonna be working 60 hours, you're gonna be traveling all the time for work. You're not gonna have time to do your 3-week, 5-week vacations. Your life's gonna be very different from what it is right now. And I think you guys are gonna be miserable. So take the lower offer. And they took the lower offer. And it's been 4 or 5 years now. I recently met up with them and they are still there in their same office, same t-shirt, even though they have multiple 8 figures. And they are enjoying what they're doing. They're happy. And I think that is a big win. I think first of all, when they said they want to walk away from that deal, that's when I had this thought that, wow, like if I was someone that gets paid on a success fee, I've done all this work. We're literally a few days away from signing the final agreement. Even the final agreement is fully negotiated. Like this would be devastating. I was thankful for our business model, but more importantly, because I didn't have like cold sweat dripping down my back, I could give them objective advice. I was very calm. I told them like, okay, well, if you go through with this deal, this is what it looks like. Now, if you don't go through with this deal, and that's when I asked them, like, why do you want to sell? Why were you even entertaining selling? And they said it's because they needed some liquidity to buy a big house. And when we kind of dug into why they didn't want to sell, it really helped them understand what they were looking for. It wasn't just for the big chunk of cash they would get, but it was also important what they would be doing afterwards. And so I think as a firm, because we bill hourly, I'm fine if I spend my hours helping them sell or helping them raise debt or spending that same time doing acquisitions. And because we have, as a firm, we have the capabilities to do buy side, sell side, capital raise and everything. If our client wants to change the direction they go into, we don't have to kind of push them to sell because that's the only way we make money. We can actually be their advisor in all those situations. And that kind of goes back to what I was talking about, like what is the vision for Embarc? The vision for Embarc is to become the McKinsey or Goldman for the middle market, where we are there alongside our client through thick and thin and help them solve all of their problems as we can as corporate finance experts. And I think that's a big misconception. When we say that we bill hourly, I think often like the biggest pushback we get is, well, what incentive do you have to sell the business then? Because if you don't get paid when you sell, then aren't you incentivized to just keep running up the hours? The truth is, if you have a success fee base, you are incentivized to close the deal as quickly as possible. I think a lot of the larger middle market investment banks, they primarily do sell sides. So, when our client decided to, or said they want to walk away, first of all, we don't get paid at close. So I didn't have like a chill running down my spine. I could stay calm and give them the advice of, pros and cons of going forward with this or walking away. And when I understood that, what they really wanted in terms of near-term liquidity, how they want to build more value, and they didn't think it was the right home for them, I was able to kind of offer that, okay, so we can help you with that as well. And because we're not just a transaction-oriented firm, even if our client decides to go in a different direction, we're positioned to help them there. And that goes back to kind of our vision of what Embarc wants to become is the McKinsey of the middle market, where we can help our clients solve all of their problems, not just a sale, but any other way to kind of improve the value of the business. I think a lot of the larger middle market investment banks, they primarily do sell sides. So, when our client decided to, or said they want to walk away, first of all, we don't get paid at close. So I didn't have like a chill running down my spine. I could stay calm and give them the advice of, pros and cons of going forward with this or walking away. And when I understood that, what they really wanted in terms of near-term liquidity, how they want to build more value, and they didn't think it was the right home for them, I was able to kind of offer that, okay, so we can help you with that as well. And because we're not just a transaction-oriented firm, even if our client decides to go in a different direction, we're positioned to help them there. And that goes back to kind of our vision of what Embarc wants to become is the McKinsey of the middle market, where we can help our clients solve all of their problems, not just a sale, but any other way to kind of improve the value of the business. When they decided to walk away from the deal, they had already spent a considerable amount of money with us, with their lawyers, but they weren't fussed about it. I mean, they recognized that was sunk cost, but the way they positioned it was, hey, we've learned. I mean, it sucks that we spent all this money, but it is what it is, and we've learned a lot from it. And we feel that we can work with Embarc to do these acquisitions, to grow our firm more and create more value, and then maybe revisit and sell later. And when they said that, I kind of felt like they got it. They weren't dwelling on the past, and they looked at it in a very constructive way. It was almost like, I actually think they used this word. It was like, well, I never gone to business school before, so this last 6 months was like a mini MBA for us. And they were using that to create even more value, which they eventually did. Having kind of like gone to the first go around of a potential sale, and we really did get to the finish line because we completed diligence, we completed the legal documentation, and we could have closed the deal, but we just hit the reset button. And so there was a lot of learnings here, certainly for Embarc in its younger stage, as well as our clients. And so over the course of the next year or year and a half, we cleaned up their financials. We started tracking the most important metrics, and when you start tracking metrics, surprise, surprise, you start improving them. So performance improved. As I mentioned, we helped them raise money, raise debt. We did an acquisition. We integrated that acquisition. And then when they were ready to sell again, this time we were armed with the right metrics, a seller's quality of earnings, a forecast model, integrated financials for the acquisition they did. We were ready to go. And that allowed them to get a premium multiple on top of what was a already significantly increased EBITDA. And that last 12, 18 months probably added another $10 million in enterprise value. From when I first met them to when we sold, the delta was more than 10 million. So significant value add in those last several months. Reinforced our belief that hourly billing is the way to go for middle market. It just allows us to do things that other people can't. I think middle market M&A advisory is incredibly saturated. There are so many M&A brokers, investment bankers out there. And this was a way for us to really differentiate ourselves, not only in the billing model, but the billing model is set up because we want to do more than just find a buyer and sell the business. We want to help them get ready for that. And that was the learning from that deal made us build out our own quality of earnings team. And then after we saw how much value add we can have if a company works with us for 12 to 18 months to get ready for a sale, that made us think about building out our own CFO services team. And so those are now the four pillars of our business, where because we bill hourly, if someone wants to sell in 3 years, we can start working with them. We work with them to optimize their taxes, grow their business, improve their financials, do a seller's quality of earnings, and then ultimately sell the whole business. So, that was on one hand, that first deal reinforced that what we're doing makes sense, and also kind of helped us really clarify what the building blocks of this business would look like. I think at the crux of it is that we are really problem solvers disguised as finance experts. Anyone can do accounting, anyone can do an Excel model, anyone can find buyers for a business, but really to be successful in M&A, which means to make sure that the client gets the best offer and successfully closes a deal that they're going to be happy with, that goes beyond really finance. And so I always emphasize to my team, we are problem solvers and thought partners to our clients, not just finance people. So that was a kind of a core value and philosophy that got formed coming out of that early engagement. Yeah, the reality is very few M&A advisors even have the capability to prepare a business for a sale, pre-exit. I mean, their fees are so back-end loaded. Very few can actually work with a company for 12, 18, 24 months to get ready for a sale. But again, look at private equity firms. They're in the business of buying and selling companies. When a private equity firm says we're going to sell a portfolio company, they start to prepare that company over 18 to 36 months to optimize for a sale, because you have to run it a little bit differently. For example, if you were to sell the home that you're living in, you don't just go out and put out a for sale sign and then have people come in. You're going to clean up the house, repaint, fix some things, maybe upgrade the appliances, stage it. So you do all this work before you prepare a home for a sale. Similarly, selling a company is not just about whipping up a sim and a teaser. There's a lot of work that goes into selling a business, so much more complex than selling a home. There's a lot of preparation work that takes 18 to 36 months. And when a business trades for 6, 8, 10, 12 times EBITDA, every dollar matters a lot. And so I think when someone is looking to engage an advisor at that critical stage, it's important to find someone that can actually truly help them through that critical moment. And someone who's not getting paid and just says, "Oh, you should do this. You should work on these three things." It's almost like, "Oh, of course I don't have to work on those three things." Well, how do I do that? Or can you do that for me? You need someone that can actually roll up their sleeves and be alongside you to effectuate that change so that when it comes time to sell the business, they would actually benefit from it with hard dollars. I think M&A advisory in particular should be really more about quality over quantity. And I encourage everyone to watch Jerry Maguire again. Um, Oftentimes, in addition to have you worked in this industry, the other question I get is, how many deals have you worked on, or how many deals did you do last year? And that's a question around volume. M&A is the pinnacle of finance. It's the most complex, difficult, and it requires a lot of time and attention. And it's kind of like, a nice car or a watch or a handbag, whatever it is. The nicest things do not come up in high volume. Like, that's like the Toyota Corolla if you want high volume. That's the Walmart. I don't want to build the Walmart of M&A. And I think that's why the M&A team is typically the smallest team in an investment bank. The M&A boutique firms are not the biggest M&A investment banks. And so I think it's important for entrepreneurs and business owners to realize that M&A is not about volume. If anyone goes around saying, "Oh, I did 20 deals last year," that means they're closing a deal every 2 weeks. Even if they did like a dozen deals, that means they're closing a deal every 3 to 4 weeks. And there is no way someone can put in the deep amount of time and attention per deal if they are processing so much volume. I think when I was at Goldman, if you did 3 or 4 deals a year, that was great. So I think it really is quality over quantity. The second thing is, especially in the middle market, because a business owner, when a big company sells, they're going to hire KPMG to do their quality of earnings. They're going to hire McKinsey to do their, strategy and other pieces. They're going to hire Goldman or some other firm to do their M&A work. They're going to have another firm for their taxes. They have like lawyers that are charging $1,500 an hour. So they are stacked with advisors. The middle market firm will maybe hire an M&A advisor and a legal advisor. Anyone can find a buyer nowadays. Let's go on ChatGPT and look up who is making acquisitions in my space, in my geography, and ChatGPT will give you the buyers. That's the easiest part. I think where founders, business owners really need help is figuring out how do I tell a story and how do I add value to my company as I lead up to the sale. And if a business has been around for 20 years, those last 2 years as a company gets ready for a sale, that could add 20%, 30% of the value. It's a big needle mover at the very end if you prepare well. So, by design, we built a firm that can do that, like the big firms like Goldman does for the Fortune 500. One word would have to be values. I don't think we were the most recognized firm. We didn't have a track record. We didn't even have a big team. But I think we won that first big break because we had shared values with our client. They understood that we had the same values as them in the terms that we are about delivering exceptional quality service to every single one of our clients. And it was more about kind of that depth than external facing volume growth. That differentiated us, that resonated with them. And again, that's why he called us the Jerry Maguire of finance. And that stuck with us, and that's always been a core value for us. And even when we onboard new people to the firm, we always remind them of our core values around client dedication and striving for excellence for each and every one of our clients.